Our first speaker of the day is Sid Norris. Sid Norris has been an active investor, trader, and student of the financial markets for over 30 years. Since 2010, he has provided market forecasts for subscribers at his website, ElliottWavePlus.com. Sid is best known for pioneering new ways to improve the accuracy and usefulness of the wave principle. In 2013, he started integrating Hurst cycle analysis into his Elliott wave counts with the objective of removing directional bias. Over the years, as his understanding of how to combine Hurst with Elliott evolved and improved, his subscribership grew substantially. Today, Sid is best known for taking Elliott wave theory to the next level by combining it with additional robust methodologies, thereby creating higher confidence, less subjective trading forecasts. Over to you, Sid.
Good morning, good afternoon, good evening, wherever you may be. This is Sid Norris from ElliottWavePlus.com. I'm going to start the presentation today with a view of my website. It is ElliottWavePlus.com. Please go there, bookmark it, and a couple of reasons I wanted to start with my website today is one, I know Jody read a disclaimer up front, but I want to show you my disclaimer as well. You'll find a disclaimer at my website. You just scroll to the bottom of any page there, click on the Terms of Service Disclaimer tab, and there it is. It's there all the time. Please go there and read that in full. If I were to summarize it in one sentence, it would be there's risk of loss in all trading. So a couple quick notes about my website. Once you are a subscriber and are logged in, depending on what level of service you subscribe to, you'll see some of these headings up here. For instance, if you were at the basic level, you will see this heading screenshots, and then you can go in and you can look at my screenshots going back for years. And then same thing on webinars. You can view my most recent webinar. I have a weekly counts webinar. I hold those on Sundays, and they're typically about 3 hours long. That's how long it takes me to get through all of the materials that I cover thoroughly. And then a little bit after when we post the weekly recording, we also post this. This is the same recording, but it has on-screen menu selections where you can jump to my coverage of particular items. So if you're only interested in, for instance, mining stocks, then you can jump straight to that, my coverage of mining stocks, and there's quite a bit of coverage there: stocks, bonds, sectors. Popular stocks, that would be primarily your Magnificent Seven stocks, other stock markets around the globe outside of the U.S., commodities, including energy and metals, and all currencies and Bitcoin. So I cover a lot in that 3-hour webinar. Also, there's a tab if you are a premium plan subscriber called Premium Plan Nightly Algo Reports. And this has all of our premium plan nightly algo reports going back years, all here. I don't hide a thing from you. I don't know of another service that leaves all of their analysis up for many years for you to go back and check. I have nothing to hide, and I want you to see the history of what I do in full as a subscriber. And so premium plan members not only get a nightly report, and these nightly algo reports are algos that send out automated momentum signals, but there's also sentiment So, for instance, um, if we were going to look at, let me look here, the Dow Jones Industrial Average Sentiment, we would see that commercials. This was Friday's posted. This is Friday through Friday of last week. Shows that commercials are heavily short and retail's heavily long. That is a toxic combination, and it's even though that's been in place here for a while, it's an indicator that when the commercials are heavily short, they're hedging, and when retail's heavily long, they're chasing. And we use that to find perfect storms, what I call perfect storms of sentiment. So when we go back here, not only do you have the automated momentum signals and the sentiment conditions, but you also have additional sentiment conditions here. And I want to point out a couple here that have been particularly excellent. So um, this is my proprietary sentiment conditions template where I look at three different levels of sort of a fast acting, intermediate degree acting, and slow acting commercials positioning. So, what commercials do, and in the case of sugar, commercials are the sugar producers. So, what they do is when the market is moving down, they start building a hedge, or they were very likely fully hedged up here. They were short, and they start taking off those hedges as it moves down. And when it is about ready to bottom, they are generally fully long on it because they just expect that it's only going to move down so far. And when the trend gets extremely stretched to the downside, they are actually fully long. And that usually is about the same time that retail traders, and that's this indicator down here, they've been chasing this thing and getting more and more bearish. And typically retail traders are fully bearish, full on bearish, almost 100% convinced that this down move is going to continue, and it is at that point where commercials are all heavily long and retail traders are heavily I'm sorry, yeah, commercials are heavily long and retail traders are heavily short, that you get these turns. This tan zone right here is where um, the ADX indicator was over 60 on a daily chart, and that generally starts to form when the trend is extremely stretched. So it was stretched to the upside here, and it was stretched to the downside here. So this really was a perfect storm, and that was in sugar. And there's been some other really great signals just recently. One was orange juice, where the down move had the commercials all heavily long, and only 8% of retail traders were bullish at this low. And as soon as you get a green candle, that is a bullish sign. It's a perfect storm, and that you can see how well that worked right there. That's just a couple of quick examples of my how we use sentiment here at Elliott Wave Plus. Also included and at our $25 level, and this is the only thing you get in the $25 level, is a daily trend report. And what the daily trend report shows is my current Elliott wave count on Bitcoin on a weekly and a daily, as well as automated momentum trading signals on the most popular uh, cryptos, and also trend charts on about a dozen different very popular tradable items. That would be the Dow Jones Industrial Average, S&P, the NASDAQ 100, the Russell, gold miners, gold, silver, crude oil, natural gas, and several popular ETFs, also Euro USD, Australian dollar, Canadian dollar, XLE, large cap oil stocks, et cetera, et cetera. So even the $25 level gets the trend charts. And what the trend charts do, there's no Elliott wave on them. They simply give you an idea of what the trend direction is on daily charts. So the trend turned down here, and it's still down. It's looking a little bottomy right at the moment on the Australian dollar, and you can see the ATR volatility stop, a custom indicator I have, is trying to stay below price right here. That's often a very early indicator that you're about to get a bounce. And got those trend charts on a bunch of items to let you know very, very simply what the trend direction is. And this is a proprietary trend template that I have. So I wanted to go through very quickly, show you my website, and if you decide to subscribe, and we'll get to the specific analysis here in a minute, just go to the first page, or you want to explore the possibility of subscribing. Let's say you want my weekly webinar. Well, you also get Wednesday and Sunday screenshots, and also get the daily trend reports and crypto reports with that. So each level gets everything under that. And when you click learn more about that item, it describes exactly what I cover in the webinars, which is a ton. And then you can go to pricing, and it'll take you to the pricing page. And there's the pricing on the different levels of service that I have. I'll just let you know right now, as an offer that I often give, a limited time offer at these annual Elliott Wave Hub events, is anyone that would like to subscribe, go ahead and subscribe. If you've never subscribed before, then send me a quick email. Okay. And for that, I'll show you. We'll go to the directly chart. So there's my email address, sid@elliottwaveplus.com. sid@elliottwaveplus.com. Send me an email. There's also a way to contact me through the contact form you'll find at the bottom of every page of my website. Um, and just let me know, hey, I'm a new subscriber. I've never subscribed before. Please refund 50% of my first month. I just subscribed. And I'll say, yeah, let's do it. And I'll go in and refund half of your first month as a new subscriber. So that offer is going to be good through the end of February. Through the end of February. I'm also would like to mention to you, and this is something I didn't tell Jody before to put on the screen, but if you would like a recording of my entire webinar from 2 days ago, Sunday, and so it's very, very current, then you can use PayPal. Send me $25 at sid@elliottwaveplus.com, and I will send you a link where you can view the entire 3 hour plus recording. And right now we're at a very critical juncture. I'm going to try from this point on in my presentation, I'm going to try to kind of roll like it's one of my webinars. So you get a kind of a feel for it. But remember, in the webinars, I cover lots of things. Like here's a list of my pages that I cover every chart in each of these pages, and there's typically between 12 and 15 charts on each one. So it's all inclusive. So you can if you that would sort of be like a free trial, except it's $25. And really, honestly, today's what I'm doing today for you, it would be like a free trial. I don't offer free trials. Today is as free as you're going to get. So I want to start with the U.S. stock indices that seems to be an area of the most interest, and would like to talk a little bit about what's been happening lately in the U.S. stock market indices. And before it's my I've got so many charts on every page that often there's a little bit of a delay between the time that I tell it to switch till the time it brings up all the tabs and everything. So very recently, we've had an unusual phenomenon in the markets. We've had literally a handful of stocks that have kept this market moving higher, and they would be they've been nicknamed the Magnificent Seven. And today, very quickly, I'll roll through those charts. This is why you'll want a recording of this presentation today. I'm not going to linger and show every aspect of every chart, but I'll show you my wave count on those Magnificent Seven today. Those have a tremendous amount of interest, and I believe most of the interest in the Magnificent Seven is coming from the retail sector, and a lot of the retail sector hasn't really, especially the younger traders, they haven't seen how vicious down moves can be in these markets. They've never experienced that. They're not too worried about it, and they won't be until they see one. And they've been jumping on whatever train is headed higher, and the Magnificent Seven has been heading higher. So this is the black line here is the RSP. So RSP is the equal weight S&P 500. So every stock in the S&P 500 is given equal weight, whereas the regular S&P 500 is market cap weighted. So the very largest and highest priced stocks um, are the ones that get a higher percentage of the value, overall value of the S&P. It's often been said that you take the Magnificent Seven, and they'll constitute over 25% of the index. So and you can see that what I've done on this chart is I've started both of those at the same spot at the January 4, 2022 all-time high. And for a while there, and then this low right here is the October low of 2022. And you can see that that the move off of that low was all inclusive. In all of the stocks in the S&P were doing well, and they were doing better than even the market cap weighted. But that all changed in March of 2023, and we see the purple line, the market cap weighted S&P, start to overtake the even weighted, and it lately the gap has been widening, and here just very recently it's really blown out much wider. So the most of the stocks in the S&P are not participating very much at all in this most recent rally that started basically on January 5. But the largest stocks have been moving up aggressively in the S&P since then. And another little side note that I think is important is from that January 5 low, you can see a clear 5-wave up structure there. So this phenomenon is universal, and it's across, and it shows up in all stock market indices. But the one that it shows up the least on is the Russell, which that includes 2,000 stocks. That's more inclusive of the entire market. The reason I'm showing you this is, has anyone ever been to a circus where they have a house of mirrors? House of mirrors. Yeah, so I haven't been to the circus in decades. I guess I took my kids when they were younger, but a little. But or the fair, our county fair will often have something like that. You walk in, and the walls and ceilings and floors and everything just covered with mirrors, and the mirrors are bent. And so it's very difficult to get your bearings in there. It's very confusing. And I think the stock market indices themselves, the way they are mostly market cap weighted, is also very confusing because there's so many stocks in there. I guess my main point here is when you trade an index, you are trading something that includes lots of stocks. Some of them are crap, and some of them are boring, and at least lately, the ones there's a very few that are keeping this market up. And therefore you're trading an average of all of those stocks. Now we can develop wave counts on those averages, but I think it is important to consider. And somewhere here, I've got a quote from one of my favorite Elliott wave counters, and uh, his name is Peter Goodburn with WaveTrack. And I noticed, Jody, you didn't have him this time, and that's okay. Hopefully, he'll be back again. He might have been busy. But this is a quote that he puts at the beginning of every one of his annual videos. Even if you are only trading a single instrument, it is best to track all market instruments as they form a matrix of related interdependency. I think that is a fabulous quote. And so many people, I think, today have tunnel vision on the S&P. And I often, I'm doing a webinar, I'm covering other things, and there's something will come through the chat. It's like, would you please get to the S&P? All I trade's the S&P. Would you just get to that, please? And the answer is no. I will get to it in the proper amount of time, because I'm trying to show what is forming, the matrix that is forming, that where there should be related interdependency among many uh, uh, different ways to look at the market. So I'm going to go through some charts here, and frankly, I want to go to the XLF first. It's the financials, and a few sectors. I'm going to get back to the Dow and the S&P. I'm going to go through those with a fine-tooth comb, but I'm going to start with a few sectors to show you a pattern that is happening in the markets that is relatively universal, except for the indices that are most affected by the Magnificent Seven stocks. So the Magnificent Seven stocks, my point is, they have been bending the mirror lately. And so we have some items that are at all-time highs right now, and we have some items that aren't. And I think XLF is a very important one to look at. These are the large cap banks. It's an ETF. 40% of this ETF is made up of Berkshire, JP Morgan, Chase, Visa, MasterCard, and Bank of America. So these are the big boys. And I think that this chart exemplifies what I believe is the best wave count overall to use in the stock market right now. So there's the March of 2020 low. And I'll show you on the Dow Jones Industrial Average in a minute that I'm considering that a black wave fourth. In other words, up from the March 2009 low, in most items, that is the end of the fourth wave up. And we are in the fifth wave up from the 2009 low right now. So examine this wave structure to the upside, and you'll notice that there's a triangle right here. Very clean, clear triangle. And so in Elliott wave, you cannot have a triangle alone in a wave 2 position. And so I'm counting this upward movement, that even though it was very aggressive from March of 2020 to all the way through January of 2022, as corrective. A, B, C for a W, then an X wave, and then an A, B, C. Well, the target for the end of the fifth wave up from the 2009 low is right here. That is where wave 5 in black, and that's intermediate degree, it would be equal to the net travel to 1 through 3 times 0.618. I always use this as the best target. And after many years of using this target, I believe it's the best target always for a fifth wave, even when the third wave is extended, extremely extended. We'll get more into that in a minute. But notice that this moved up correctively almost all the way. I would say over 80% of the distance to that target. And therefore, because this was so aggressive, I labeled this pretty much in real time as the end of wave one of an eventual ending contracting diagonal. Because each wave of a diagonal, like a contracting ending diagonal, theoretically, according to the Frost and Proctor, must be a zigzag or something from the zigzag family. So this would be a double zigzag. There's a zigzag there, then an X wave, and then there's another zigzag. And notice that this last bit of movement up in a very small ending, expanding diagonal. I never, ever counted this as high as the stock market would ever go, like most other Elliott Wave organizations did. And the reason is because of two reasons, Fibonacci and Hurst. So that best Fibonacci target was not reached there. This was obviously not a five-wave impulse, because you can't have a wave two in alone that is a triangle. So what's been happening since then? Well, you notice XLF moved down from that high in five ways. One, running flat for two, three, four, five. And then I believe that we've got a very easily recognizable structure in the XLF, and that was an A, and then a triangle, A, B, C, D, E, and that would end wave B. And this is a five-wave up structure for green wave C. Green would be minute degree. And it has very nearly reached, based on some news that just came out today, the CPI came in hot, and that could maybe the catalyst for the end of the road of this move to the upside that we've been seeing in the stock market. It just happened this morning, just prior to the start of this session. So I don't use the same Fibonacci targets as is shown in the Frost and Proctor. I think that those are wrong. And I think he's wrong on several important things. And one is, I think he's too stringent on his rules about each leg of a diagonal must be a zigzag. I think it's just, I've seen too many diagonals that break one or more of his rules that he lists in his book for a diagonal. But anyway, I think we've got an A, B, C zigzag here. The XLF is not above the all-time high. It has failed to reach it, but it has reached very close to where wave C was a 0.618 expansion of A. So to figure that, you figure this is a unit of one, the green A, take it times 0.618 and add that total to the top of A. And so very early, as soon as this wave A is able to be labeled as a wave A, you can set this Fibonacci target. You don't need the B to set the fib target. All fib targets must be shown on a Semilog chart in order to get the same answers that I'm showing you here. And the Fibonacci tools must use Semilog for the drawing tool. For instance, there's lots of traders on Thinkorswim. Thinkorswim won't do that. One platform that will do it, I have found, is pretty usable. Recently examined it, is TradingView. So in TradingView, you can set the chart to Semilog, and you can set the Fibonacci tool to Semilog. But anyway, so this is what we call a terminal thrust from a triangle. It should carve out five waves. It's in the fifth wave. That fifth wave may already be over, and it's come very close to that Fibonacci target. And then in a contracting diagonal, you would then get the finish of wave two. Each leg of a diagonal typically is a deep retrace. It's typically a 66 to 81% retrace, according to the Frost and Proctor. So you'll notice I also am using Hurst on here. And so Hurst analysis is bearish from February 16 through June 16. However, the window for this next large cycle trough it could move down all the way until through into October, based on what I call manual phasing. So in her cycle analysis, this was a 9-year cycle trough, and then you get the first within a 4.5-year cycle trough or a cycle, you get 3 18-month cycles. So there's the first one through here. There's the second one through there, and or actually through here, according to her. So I think it was probably here. That's why this could last longer, this last plunge. And then we get the third one, and that constitutes a 4.5-year cycle. Notice I've gone back and to the last 4.5-year cycle, and this black cycle finder that is inside of my Trade Navigator platform. If this 4.5-year cycle is the same duration as the last 4.5-year cycle, we'd go all the way down through October, and that would give us time to move down this year, at least to this level and possibly much deeper. So XLF is one of the items in this related matrix of related interdependencies of these important sectors that it has not made a new high here, and a deep retrace is still on the table. What other sectors are like that? The transports. So in the transports, you had this out of the March of 2022 low, you got this aggressive ABC zigzag, and then that was followed by a 5-wave structure down, and then we very likely got a B wave. We still need to finish this wave 2 of this ending diagonal. There's the target for the best target for the end of black wave 5, and that would be up from the in this case up from the March 2003 low. 1 in black, 2 in black, 3 in black, 4 in black, and then 5 in black. So this rocket ship move out of March of 2020 almost hit that level. And so I think it's going to be a gradual, choppy finish to this diagonal. And the next thing that's going to happen, it should be some pretty strong downward movement into at least July. What else is forming the same pattern? Utilities up from the March of 2020 low, up for wave 1 of the diagonal, 2, 3, 4, 5. And then let's see. And then of course I already showed you the financials are showing that same pattern. Now I'm going to show you the Russell. We'll just take a quick peek at the Russell, but the Russell is actually the item that first gave me this idea that the up move from the March of 2020 low was actually wave 1 of an ending contracting diagonal. So we'll wait for the chart to change over to the Russell here. So I see a few questions. My platform that I've used for decades is Trade Navigator by Genesis. I hope that Genesis stays in business all through the end of my life, because I've got way too many charts to be trying to draw them up again in a different platform. And another question came in, can I explain the difference between Thinkorswim and TradingView? And the difference is Thinkorswim, you can't set charts to Similog there, and even if you could, or they added that, their tools don't draw using Similog math, and therefore you would get different Fibonacci targets doing it yourself than what I would show you here. Okay, what other items have not made a new all-time high? Well, COMPQ has not. It's come very, very close, but it has not made a new all-time high here. COMPQ is the entirety of the NASDAQ, whereas NDX, the more popular tradable instrument, has easily made a new high above the high that it saw back in the former all-time high back in November of 2021. And then the Russell. On the Russell, if you start way back here at the 2002 low, you have 1, 2, 3, 4, and then you'd need a fifth wave. But this rocket ship move when it happened out of the March of 2020 low was so aggressive that I felt like it was very likely an ABC and had labeled that wave 1 in real time. You can see the eventual target, best target for the black wave 5 isn't much higher than that. And and notice how far the Russell is below its all-time high. It's falling way short. And therefore, this diagonal idea works perfectly here as well. So very quickly, I did promise you I'd run through the Dow and the S&P. Hey, Johnny, anybody that wants me to cover something that I don't have time to cover and I'm running late already, I haven't covered anywhere close what I cover, send $25 to my PayPal account using PayPal. And in the note field, say, hey, send me the link to the recording of your 3-hour webinar from Sunday, 2 days ago. Otherwise, I may not get it. It costs you $25. If you're not willing, once you see all the things that I do here, if you aren't willing to shell out $25, then, what are you looking for here? Are you looking for a tip? It's amazing how many people can come to these webinars and they're looking for a tip on a trade they can put on for the next hour. Uh, so anyway, looking at the Dow Jones Industrial Average, my PayPal account is Sid at ElliottWavePlus.com. Sid at ElliottWavePlus.com. You're welcome. Sorry, I have a lot of people coming at me for free stuff all the time, and I really get tired of it. So here is the look at the long-term Dow Jones Industrial Average, and this is an important chart. You might think, well, there was this make. I'm just trying to make a trade. And here's why it's important, because there's 3 Fibonacci targets up here that are all fairly tightly together that haven't been hit yet on the Dow Jones Industrial Average. The first one is this one, it's 41,020. That if the Dow Jones Industrial Average makes it up to that price, and looking for 5 waves up from the 1932 low, cycle degree or teal, 1, 2, 3, 4, and then extremely extended 5th wave. But if the Dow gets to 41,020, the wave 4 low in 1974 would cut the entire distance from 1932 low to that high by the golden section. Okay, and then within this extremely extended 5th wave, 1, 2, 3, and by wave 3 was a 4.236 expansion of 1. So you measure this as 1, take it times 4.236, and you get that almost that exact high. And then ABC down for wave 4, and expanded flat. And so wave 5 would need to be equal to the net travel to 1 through 3 times 0.618. And that level, very important level, is at 41,981. And within the 5th wave up in the Dow, 1, 2, 1, 2, 3, 4, 3, 4. We're in the 5th wave up. And the 5th wave up would have to be equal to the net traveled of 1 through 3 black times 0.618. So there is the expectation that the price will make it up into that target zone. So why is that so important? Because up from the 2000 March 2020 low, the ABC pattern reached 80% of the distance to that level. And this, as it turns out, on the Dow, the S&P, and the Nasdaq was not as high as the stock market is going to go forever, as so many mainstream Elliottians were counting it. I'm not included in that group. And then we would, so that would be wave one of the diagonal. Then we get an ABC for wave two. Now, theoretically, this should be a zigzag. And this has made a new high here, which really shouldn't happen in the zigzag. But because of the related interdependency of these charts that I'm in showing you, I still think it's possible that even though this squeaked out a new high because of the magnificent seven stocks, remember they're bending the mirror on a lot of these indices, that we could still get a deep wave too. And we end up finishing, and Hearst on Dow Jones Industrial Average doesn't think the market's going to top until May of 2026. Here's a closer look at the structure. Okay, so this move to the upside in the Dow is when also, I already showed you the triangle that occurred in the financials. This is a very important structure, and it's not showing on anything else. The move up in the S&P was more gradual, and it was not an obvious ABC, but this is an obvious ABC structure. It started with a 5-wave up structure for A, and then 3 waves down for A, 3 waves down for up for B, and then a 5-wave down structure for C. That is a running flat. And so this move that we've seen to the upside since October should be a 5-wave structure. And the best Fibonacci target for the top is where you get a wave C in green that is a 0.618 expansion of A on a semi-log chart. So that is a distance of 1. Take that times 0.618. I've had this target on my charts for a long time, and it hit it yesterday. And and then today, the CPI came in hot and the market plunged. So I'm going to go on through the rest of these charts, but the market needed a catalyst for a top here, and it's possible that we actually got it this morning. But that's important Fibonacci target is what I've been looking for. And then let me go back to the weekly. Is it possible that the Dow moves down and the wave 2 of the diagonal happened here and it was abnormally shallow? Yes. So but that still would allow for a 20% decline between now and approximately the third quarter. And there's a large cycle, Hearst cycle trough due mid-year, possibly all the way to September. And so I think we're going to see a decline of either 20% or 40% if this is still in a normal, fairly normal diagonal where you get a deep wave 2. The thing that really shouldn't have happened in that scenario for the deep wave 2 would be the new all-time highs here. And that's why the bottom line is that on many items, the Russell, the XLF, utilities, transports, it's very likely we're going to get a deep move for wave 2 next, and if we're in a diagonal, because those have not made a new high. Is it possible that the Dow, the S&P, and the S&P have a more shallow pullback? Yes, I would say that it's possible, and that's why it is my alternate count. And then let's see here. Well, in order for this to be a wave 3 to the upside, this move up would have had to have been a 5-wave structure, and it wasn't. So if this was a 5-wave wave 1, and this was the end of wave 2, and maybe this is a wave 3, and it just keeps going up. So that was the question, and I knew I would get that question. And the answer is look at the XLF. Remember the interrelated dependency of these patterns. Look at the XLF. It is in a terminal thrust out of the triangle, and it's probably done with the thrust. And can't have a triangle in a way alone in a wave two position. That would have to be the case in the XLF. So no, I don't see. And then the other thing is of that Fibonacci target zone that I showed you. It's extremely important on the quarterly Dow Jones Industrial Average. So no, I don't think this is going to just keep rocking to the upside. I think it's matter of fact it may have finished yesterday. So there's the weekly. The daily chart, you can see this clear five-wave up structure for A, the running flat for B, and then the five-wave up structure, all culminating by hitting yesterday this target right here. Where wave C was a 0.618 expansion of A. So there was my target zone. On a 60-minute chart, this does not have today's price action, but I can tell you today we had quite a aggressive response to the CPI coming in hot. Excluding food and energy, the CPI is at 4.8% per year. Including food and energy, it's at 3.7. So they're always talking on TV about the 2% Fed target. Well, what they do on television is they try to make everything that happens about the Fed. In point of fact, what the Fed really does is they adjust their interest overnight lending rates between banks with about a 5 to 7 month delay from what the natural market does. And I'm totally running out of time, so I'm going to so now we're talking about the Fed. Let me go to the bonds. And we're going to go to take a quick look at the bond market. And what we'll see is that the bond market started moving down and therefore rates started moving up back in, we'll go to ZB contract, 30-year. So that occurred back here in March of 2020. So you started seeing bonds move down aggressively, and that's when interest rates started going up. However, it wasn't until about right here in March of 2022, I believe, where the Fed started to finally acknowledging that that the bonds trend had changed. Normally, they would start, and each one of these dotted lines is a year. They would start adjusting their interest rates to match the natural bond market at about a 7-month delay. So they probably should have done it here. And they waited like a year too long to start adjusting the rates, and that allowed inflation theoretically to catch hold and catch fire. But the fact of the matter is they adjust based on a delay. So when they saw this move up off of this low starting in October, that was their clue. So it's like, hey, bonds are going up, rates are going down. We may not have to raise anymore. It's just as simple as that. But they make it out like they're in charge of fighting inflation or not. Well, the fact is we're at 4.8% excluding food and energy inflation right now. Is that 2%? No. But they stopped raising. Why? Because bonds stopped going down and rates stopped going up. And every time they raise, it makes it more difficult for the stock market. One additional thing I'll say is there is typically, and we'll go back to the bonds here, or Dow Jones Industrial Average. There's one particular chart, and I've only got 5 minutes left, so this is going to, and then we'll look and see if there's any questions that warrant an answer. Going to go back to the Dow, and there's some commentary about the Fed. This isn't all about the Fed. It never is all about the Fed, but on TV they make it out like it is, and it's just not. But the Fed's going to adjust rates with a lag to kind of chase what this regular bond market is doing. So in October of 2022, the 3-month and the 10-year bond yields inverted. And so and then the Fed was raising, but their last raise was in July of 2023. On average, there's an 11-month delay to the onset of a recession from that point, from the point that they make their final rate increase. And so that 11 months forward from there would be June. It would be June. And that's exactly when Hearst thinks that we would move down through approximately June. However, I think it could move down through September 2024, because I think the cycles are going to gradually get a little longer as this diagonal occurs. Diagonals are there for a purpose. They are eating up more time before eventually reaches its target. So Jody, 3 minutes left here. Do you have any questions that need to be answered? You see any?
No, I think you answered the questions.
Okay, then I can flash through maybe in this last 3 minutes. There was an ask about GDX. And so I'll show you GDX real quick, the miners, gold miners. And I think, oh, here's another thing while that's loading up, I'll show you. This is a Hearst analysis of the US dollar index. And it's been moving up, and this orange line here is the composite line, and it should and that tops approximately in early to mid March. This is one of the most important things, and that I'm going to talk about today, and it's in the last 2 minutes, is that Hearst is really bearish on the U.S. dollar down pretty much through the end of this decade. Here's a closer look with some labels. So the composite line goes up through March 13 on the Hearst analysis. There is a nest, a 20-week cycle nest centered on no later than March 21. So I think we're within a few weeks of an important peak in the US dollar index, and then very, very bearish. That's going to have ramifications. I think it's going to have ramifications on precious metals, especially. And so I think precious metals needs to finish a little down pattern here. There's the gold miners weekly chart. If you want to see the daily or any of the individual miners, I count Barrick and Newmont, and but anyway, this is a very bullish chart, and these should do well when the U.S. dollar, especially starting when the U.S. dollar peaks. So 1, 2, 3, 4, 5 waves up, followed by 3 waves down. Textbook, that's a 1 and a 2, and then another 5-wave up structure. And this sideways junk is all a wave 2, I think, and I think it's a very near completion. Probably will complete in March, and then it's up and away, in a big way on gold, silver, platinum, and many of the mining companies are associated with those metals. Sorry I ran out of time today and couldn't show you more, but that's all for me. Remember, go to Elliott Wave Plus. You can contact me with the contact form at the bottom of the page there. If you would like my full recording of my webinar from 2 days ago, send $25 to my PayPal account. That is Sid at ElliottWavePlus.com. If you want to subscribe, and you never have subscribed before, send me a quick email. Say, hey, I'm going to subscribe. I'd like 50. I've never subscribed before. I want 50% off of my first month, and I will immediately refund your 50% of your first payment back. Thank you so much, and enjoy the rest of the day with the other presenters. I'll turn it back over to you, Jody.
Thank you so much, Sid. That was very enlightening. And Sid gave you his information. We're also going to be emailing out the offers page for all of the presenters after the event. Thank you so much, Sid.
You're welcome. Thank you.